Turning back now to the markets, Fed Chair Jerome Powell less hawkish than feared yesterday, while that sent market rate cut probabilities up a little bit. But for each month, it did not move up the timeline. The first cut is not expected until the end of the year still. So where does that leave investors? Our next guest says it should not leave them on the sidelines. Joining us now is Julie Biel, the chief market strategist, also portfolio manager at Kayne Anderson. Julia, thank you very much for being here with us. I'm sorry we couldn't get the video link up for you. Technical difficulties there. But take us through the rate picture right now as you see it and why people and investors should not stay on the sidelines in this market.
Right. Well, I think if you look at the outlook overall, there's a lot of balance because we have a strong economic backdrop with employment very strong, wages very strong. Sentiment is getting a little bit softer, and I think that's really a function of oil prices. But then we also have $1 trillion of credit card debt. We have a deficit that is more in line with 7% unemployment than 4%. And so I think there's a lot of puts and takes, and what that means is there's not a lot of leadership in the market, and there's not a lot of conviction one way or the other. What we think is it's really hard to understand what the outlook is going to look like for the next 12 months. You really do want to stay invested. There are enough positives to really support, but you want to focus on quality so that you're protected if the economy does weaken.
Okay, so that quality, where do you find it, Julie? Where do you find that quality? Is it defensive names? Is it in real estate? It seems very uncertain given the rate outlook.
I think it's less about sectors, and it's really more about the individual companies and the competitive dynamics that they have. So businesses that have low levels of leverage are really absolutely critical in this environment. Doesn't matter if it's small cap, mid cap, or large. You really want a very pristine balance sheet. But I think right now, if I look at earnings, there's a lot of volatility in earnings, which to me signals that investors are using the rate picture to kind of decide where valuations need to be, and that at earnings, we have a true up based on fundamentals. So I think right now the place you want to be is in companies that have durability to their earnings, not necessarily just very strong growth. And so companies that are like, I would think of a Verisk or a Fair Isaac, where you have a lot of durability to the earnings, you can kind of count on them in a way that you can't with some of these flashier, higher growth companies.
Now, if you take a look at those, the leverage thing is very much a part of the story right now, given the fact that certain companies that rely on debt markets may be dealing with higher interest rates. I wonder, are your clients also asking you about whether or not they should be gravitating towards other income areas of the market, specifically corporate credit, whether that's investment grade or even high yield or junk debt?
Yeah, absolutely. I think it's really interesting to be an equity investor right now when you have opportunities for fixed income, in the 6, 7, 8, 9, 10%. That's, equity-like returns for investors. And so if you're in equities and you're concerned about the level of volatility, some of that is very, very compelling. I think my concern is most of these, a lot of this debt was raised in the absolute best of times. And so I have a little bit of a concern that some of this junk or private credit may not be of the quality that we would hope for. So I think absolutely there are really good opportunities to be had in the fixed income markets, but I still think you have to have a focus on quality even there.
Okay, now.